It's showtime. Let's see. So Paulina, come on in. We're just opening the doors to get ready for our webinar that literally 1 minute after the hour we're going to launch into. Got a front row seat. Lots of webinars. And I got two great, we're here as a guest of Giselle, and I got my growth CFO lead, Jose, with me. So we're definitely going to dive in today, get some things done. I see Dan is here. David, welcome to the show. So, hey, as you come in, to help us know who's in the room and how to guide the conversation, if you could put the city that you're in the chat box, then we'll get to know each other. I happen to be in Bethesda, Maryland, right outside of Washington, D.C. So it's an interesting place to be, these last few months. And how about Jose and Giselle? Where are you guys located? I know, I already know, but
yeah. So I'll let you go first, Giselle. Go ahead.
Yes, so good afternoon, everyone. I'm Giselle Stoltz. I'm the director of the Mason Enterprise Center, and I'm based just in Fairfax City, which is outside Washington, D.C., and Fairfax is where George Mason University is based. So it's the nearest suburb of Washington, D.C.
Yeah, it's right there. It's got a lot of people. How about you, Jose? Where are you?
Yeah, so I'm sitting here in McLean, Virginia, right outside of Washington, D.C., not too far from the rest of the cohort here. But to make it clear, I'm a California kid. So I'm always living, my watch is even set to San Francisco time. And I reset everything forward to DC.
Yeah, Paulina's in Gainesville, so welcome to the event here. We got Arlington, very good. Is Julia no microphone? Alexandria, so a lot of kind of hometown folks here. Yeah, Gary, so welcome. There's a lot, the DC area, the DC metro area, there's a lot going on. I came here from Houston almost 30 years ago with the Army, never left. There's just too much to be part of. Okay, so Giselle and Jose, you ready?
Ready.
Let's make it happen.
We're gonna kick things off. So Giselle, do you want to introduce yourself more fully, and then we'll get moving?
Sure. So my name is Giselle Stoltz. My mother is French, which is why I have a French name. I am based at George Mason University, which is, for those of you who don't know, which is the largest public university in the state of Virginia. My role now is currently I'm the incubator director for the Mason Enterprise Center. But pretty soon my role is going to be changing, and I'll be responsible for all the entrepreneurship programming and events for the university, but not from the undergrad, but for the graduate, postgrad, and community. So my role is in the economic development role of Northern Virginia. And we one of the things we do is that we organize events such as these, which are open to the community, to try and help small businesses and startups learn some skills that they need to grow. So thank you again, Kirk and Jose, for conducting today's class.
Yeah,
Jose.
Thank you for having us. So Jose, what brought you here today?
Yeah, hi everybody. My name's Jose Villarino. I'm one of the leads here at Foresight CFO. So first of all, good morning to the folks that are on the West Coast and Central Time, and good afternoon to the folks on the East Coast. Hey, so real quick, my background, I'm an old-fashioned finance guy. I spent a lot of time trying to figure out how to squeeze more cash and value out of companies so we can increase that CEO's opportunities or that leader's opportunities going forward. I grew up in the technology field in different forms, and as a banker, as a CFO. I've worked in private equity, and most recently I've been spending a lot of time working with companies that are in transition, be it growth mode or kind of looking for that next evolution. And like I said, I really focus a lot on how do we squeeze out more cash? How do we get the cash flow going so we can increase that valuation, all else being equal? I look forward to having a chat here and hopefully follow-up questions after this.
Yeah, and definitely on that point, I mean, definitely, as we go through the event here, the experience, if you answer the questions in the chat box, again, if you have a question, put it in the chat box, and that way, a little more of a interaction, more normal in that sense. And so my name is Kirk. I'm the CEO of Foresight CFO. In addition, global company, 32 people on 3 different continents, really helping CEOs use the numbers to make better decisions and execute, right? So that the financial impacts that you want are coming through. And the position, we're kind of thinking about things, we're going into 2021 really fast. So how do we use the numbers in some cases to survive? Because the business climate has changed so much this year in completely unanticipated ways. And for other folks, thrive. And then, for all of us, survive and thrive during the period of massive uncertainty. So just kind of to frame things out a little bit here, seriously, between, coming into 2020, January, February, pretty normal, but then all of a sudden March, things came to a complete halt for a lot of businesses. I mean, you got COVID, just running through, on a national level, not sure how to respond to it. And then, that accelerated, social unrest, social justice, where, in a very real way, a lot of cities are on fire. I mean, DC right now is boarded up because of expectations around the election, which now looks like it's going to be a contested election, which is not a surprise, given kind of how we went into this. And so these are driving changes. I mean, companies who never thought they could work remotely, virtually, like we're doing right now together, are actually doing well, right? So what does that do once an employee gets accustomed to working from home? Do I really need to be in the office every day? And can you recruit people who are in a different geographic area? Do you need all that office space? These big fundamental questions, including who's the right customer for you? Where do you have growth potential in the marketplace? Who has the ability to pay you for the products and services that you deliver? There's just for a lot of companies, there's some of the things that were in place in previous years are being rethought or are altogether changing. So today we're going to talk about being on the offense. How do we use the numbers to gain that clarity, confidence, and the financial impacts you're looking for? And what we're going to establish is the habits of profitability, right? These are the best practices that give you clarity. You're using the number story to identify exactly where to lean in, and you're able to see things before they happen, so you have time to make modifications. So the habits are making sure we have good numbers, manage cash well, create our financial roadmap. Then how do we use benchmarks to drive performance so we're not limited to what we know internally? And then identifying the right growth options, right? What really matters to my business now and across the whole journey, from foundation all the way through having success, 7 succession options. So Jose, do you want to take us through a poll here? Yep, you're on mute.
Sorry about that, guys. Just to kind of set the stage here for everybody and kind of understand who's in the room. Let's start with the first question. What was your top line revenue last year?
Yep. Oh, yeah, I gotta find my control panel disappeared. Here we go. Okay, now you can see the question. So
there you go. I'll ask you, Kirk. Yeah.
There you go. Okay, so the first question is, what is your top line revenue? And the second question, we're literally at year end, this year with COVID, do you expect your revenue to increase, decrease, or stay about the same? Right, and then your responses are anonymous, but this gives a good idea about who's in the room, and we can bring in examples, based on the size of companies that are generally here. So we're at 50%. This is the year that your vote counts. So we're at 60%. We get to at least 70%. It'd be fantastic. And I'll hold the vote open for just a moment longer. At 63. So yeah, 66. A few more votes and we're there. So 2 questions. And again, your responses are anonymous. But we'll know, all right, we hit 70%. So I'll keep it open for just another minute. Okay. There you go. I'm going to end the poll, share results, and this is what we're looking at. So largely, except for 2 companies, we're all in that $0 to $5 million top line revenue range. And take a look at this. We got, roughly, it's almost a third, but a third expected increase and 42% the same, and 27% are decreasing. So, I mean, that's fantastic. So for all of us, if we're growing or if we're losing ground, let's figure out how to use the numbers to engineer that profitability to get back to where you want to get and get back on that path. Okay, thank you. Okay, Jose.
Yep. Shall we move on? Tell you what I want to do next, Kirk, you should be on slide 5.
Yep.
Let me talk you through a case study, and this is actually one of my clients, which we thought would be a good place to kind of start the conversation today, and tell you a little bit about how we look at companies. We really do think about companies from 3 different viewpoints. One is what we call the annual performance cycle. We'll touch on that this afternoon. We talk about the phases of the financial performance. Where are they? And what are the 8 drivers? And we're going to touch on all of this today. But to set the stage, I wanted to kind of do a little case study. One of my clients, a telecom company, 75 employees, approximately $30 million in revenue, right? And they were in a situation 2 years ago, really a little over a year ago. It was kind of the beginning and mid Q1, Q2 of 2019, where the CEO realized that he didn't have real visibility into the company anymore. He didn't have confidence in the numbers. There's no transparency into the performance. And he knew right off the bat that there was just no impact. He wasn't having any impact, and he couldn't figure out why. But he was able to take a step back, which is what good leaders do, right? You kind of take a step back, try to understand the situation. He figured out some of the challenges he had. He figured out where some of his strengths were, some of his weaknesses. And the first thing he did was bring in a strong COO. He brought in this gentleman and said, you now are my eyes and my ears. This is what I want to do. This is where I want to be a year from now, 2 years from now. Then that COO turned around, looked at what he had in-house. What could he do? How was he going to get to that point where he had transparency in the numbers, transparency in the performance, confidence in the numbers, and having the impact which the CEO was looking for? And what he did, he says, okay, tell you what, first thing we're going to start doing, we're going to start figuring out the foundation. We're going to touch on this afternoon. The foundation is making sure that you can understand the numbers. What's it looking like? He brought in a really strong accounting manager. Then he says, okay, I've got all this data. What am I going to do with it? That's not his strength. He brought us in. And we came in and we started to think through what's the ultimate goal? How do we get from here to there, step by step? And then more importantly, figured out what are the KPIs? What are the things we're going to focus on that we know are going to make a difference? And we started to put all that together, and it didn't happen overnight. Let's be clear about that. And we work in 90-day sprints. So when we start putting plans in place, and I was working side by side, partnering with the COO and eventually his team, I'm part of his team, and I sit with them every week. We started thinking about how we're going to get there. We started breaking it up into these goals, into these 90-day sprints. And what could we focus on? What would have impact? And more importantly, what can we measure? Now that we had transparency into performance, we had confidence in the numbers, we can start to measure things, right? And understand what we're measuring if we're making an impact. So as a team, as a partnership, we started putting this in place. And over the last 18, well, not quite 18 months, but a little over 12 months, we've gone to a point where we've gone from, and you can see that there in the client quote, he went from getting people from a theoretical stage to one of action movement. You have to put time. People started thinking about how are we going to achieve things. Talking about, one of his key things was getting from the decision by assumption, which is where the CEO was, right? Here's my gut feel, here's my experience, to a point where it was managing by the data. Now, one of the things I'm most proud of with this company is we don't do anything. We don't do a new product. We don't do a partnership unless we create a business case. And that business case is based on numbers. So once again, we might still make decisions on gut, and the CEO might say, hey, I love your analysis, but I still want to do this. But now we can actually say, look, here's the information, here's the data. That's where we start to get transparency. That's where we start to get confidence, and we start to have impact. But more importantly, what we've discovered, it starts to build, let's say, peace of mind. We're going to keep coming back to that. That peace of mind is that you can start looking forward. You can start to understand what you're going to do and where you're going to go. You can start to breathe a little bit more. You're not reacting. You're getting to a point where you're being more proactive. So with that, that's our case study, and I'm happy I can talk on this for hours, but we'll get to that later on if you have more questions on it.
I remember there were surprises, like there were those aha moments where the team was using, the CEO was using a certain set of numbers. You come do some work on it, say, the
Oh,
numbers that
absolutely.
they're
I mean, when you
using
start
are,
doing these things, there's a lot of aha moments.
yeah,
Until you start thinking about the future. And one of those, as an example, we have what we call a BHAG, right? A big, hairy, audacious goal. And that BHAG entails some very aggressive sales numbers. And it sounds great when you put it on a whiteboard. We're going to do this. But with the big aha out of that particular initiative within the BHAG was we got to the point where, well, the challenge is going to be customer acquisition. How do we get there? You start understanding the dependencies. But the positive here is that you start being proactive. You start thinking about it. You're not reacting. And that's probably been the biggest culture change. When you start doing these functions, you start doing this, you get to breathe a little bit, look forward, and you're always going to run into surprises, right? It happens everywhere. Things go pear-shaped. But when you can start looking forward, you can be more prepared for some of those things.
yeah.
Those hurdles might become speed bumps. And that's a huge difference.
Very good. So let's kind of think about this. So with so much going on, it would be easy for us as CEOs, wait and see, that kind of thing, right? You could have waited and see a whole year now, and it looks like there's the end in sight is not quite in sight yet of what's going to fall out from the pandemic and the political environment and kind of some shuffling supply chains. So sometimes avoiding the tough work, especially when you're dealing with the cash burn or other financial challenges, it's easy to avoid it, but experience teaches us that in hardship, when there's massive change and uncertainty, that's the time to take action. Use the numbers to understand your market, size things up, see things clearer, and literally take the offense. And so we're going into 2021 really fast. And if you're not already doing it, this is the time of year you'll start, that stage one planning. How did your clients perform this year versus last year?
Hey, Kirk, real quick, can you confirm that your slide set is being shared? I'm seeing this in the chat box and folks are having questions.
Okay, that's good. My control panel disappeared for some reason, so I'm glad you said something. How about
now?
You get it now?
Yeah, I can definitely see it. Yeah, it's up on my screen again.
Okay, I appreciate that.
And I think from looking at the chat box, people are seeing it as well. There we go.
Yeah, but yeah, there was a glitch, and for some reason it disappeared. So I appreciate you guys speaking up. So let's, so kind of backing up of the offensive going into, 2021 is coming up really fast. I mean, and so this is the time, if you're not already doing it, do the planning and analyze your current clients. How do they perform this year versus last year, right? Where do you have momentum going into 2021 with? And client acquisition, you get your current clients you want to keep and grow, as well as the new clients. I mean, how did that rate of acquisition change year over year? And so and gross profit, are your margins what you expected them to be, and what's the trend line, better, worse, compared to what you expected and previous years? So planning, and then that'll give you what you need. Planning, analysis, looking at what's going on, that'll give what you need to start that, stage two, that budgeting. What is that 12-month rolling forecast going to look like? We'll look at an example of that as Habit 4, that how do you engineer profitability with budgeting. So, if you could put in the chat box what you're doing to plan. Have you started? If you started, what are you actually doing? Where are you finding challenges? And we'll pull that into the rest of the discussion here as we dive into the first habit of profitability, and that'll be one that Jose will make us smarter on.
I'm certainly going to try. So the first habit is really the foundation. It's the numbers. Do you have numbers you have confidence in, right? And that goes down to your reporting. Might have different. You might be running your business on spreadsheets. You might be running it on QuickBooks. You might be running it on NetSuite. But the whole idea is, do you have confidence in the numbers? Are your processes in place? So you can look at numbers on a monthly basis, hopefully on a weekly basis, but let's say at least a monthly basis, quarterly, annually. You can start to understand what's happening. And I'm going to keep referring to something that's big for me, which is a story behind the numbers. Just having a 5 on a spreadsheet doesn't tell you anything. You can say, hey, it's a 5 compared to a 4, or it's a 5 compared to a 7, but it doesn't tell you anything unless you understand what drove that change. And you do that by being able to look at numbers on a regular basis and having confidence in those numbers. And although it's a cliche, it's true. You're going to manage what you measure, right? If you have access to something and you say, this is one of my key performance indicators, a KPI, I saw that in the chat box. Every business is different, and every manager, every leader is different. You might have what works for you to steer that bus. It might be different for someone else in their business. And it'll change from industry to industry. It'll change, from business to business, leader to leader. But the important thing is to have that foundation, that you have the right numbers. And then once you've got those numbers in place, you can start to understand what's happening with the numbers, what's changing period to period, week to week, month to month, quarter to quarter, year to year. I'm a big bridge guy. So I work with a lot of my clients, everything we do. When we start reporting numbers, we create a bridge. How did this change from, let's say last month's net income to this month's net income? Then we go line by line practically, or in big buckets: revenue, gross profit, or I'm sorry, COGS to gross profit, operating expenses. And you start to understand what's happening. And the first time you do it, it's a little tricky. It's a little lumpy. The second time you do it, it's less tricky, less lumpy. By the third time, you get into cadence, and it becomes just part of the normal conversation. Every month you're measuring, every period you're measuring, week to week, trying to think about what is changing. Why did it change? What did I do last week or last month, as an example, that raised revenue? Well, did I spend more money in marketing? Did I happen to acquire a new customer? Why did that customer join me? It starts to create more questions, but questions that help you get smarter, right? And as time goes on, as you start diving deeper and deeper into this and rolling through it, you start to understand things better. You start to think forward. You start to be proactive. Once again, I'm going to keep saying it. You're going to hate it by the end of this presentation, as opposed to being reactive. You start thinking, and that's when you start. And we'll get to this in a few slides, but it's when you start getting into a roadmap, into a plan, into a longer-term plan. You're no longer looking back and reacting to something that just happened, but you're looking forward. You're trying to think about where you want to be, how you want to get there. It's not a guarantee that it's going to be perfect or that you're going to get there, but at least you're thinking about it and you're being proactive to it. Next slide, Kurt.
Yeah, literally, and Jose, there's questions coming out about, what does KPI stand for? So let's break it down a little bit about KPI and how do you pick that first thing to measure?
Sure, absolutely. So KPI is a key performance indicator, and it's going to be different from company to company. But let's take a real simple one. Everyone for the most part, most people understand what a gross profit is. In classic accounting, it's your revenue minus your cost of goods sold, and that's your gross profit. And then you can also, from gross profit dollars, right, you can calculate your gross profit margin. And from period to period, week to week, month to month, you can track how is that changing? How many gross profit dollars are you generating? And what does that mean in terms of margin, right? So that in and of itself is a KPI. So you can start tracking that. But what you're going to find is just knowing that one number doesn't tell you necessarily what impacted it. So period to period, you partner with someone, you bring in, you work with someone you trust, someone who's got your best interests at heart, and you sit down and you figure out, okay, my gross profit dollars increased by Y. Is that because my revenue increased or because my COGS went down? Or they went up at the same rate because my gross margin didn't change, my gross margin percentage. So once again, you start kind of thinking about what the KPI is, but then you start understanding what are the drivers that is changing that KPI. And the way you do that is you start creating a dashboard or a scorecard, as we call it. And these key performance indicators, for some people, it might be revenue, for others, it might be, it could be gross profit, it could be operating profit as a percent of revenue. It's going to depend company to company, leader to leader. It could be on your cash flow statement. How much cash am I generating? But these are the types of things you're going to start putting into a spreadsheet, into a portal, if you will, depending on how what kind of systems you have in place. And you can start looking at this on a regular basis. And then once you start kind of understanding how you got there, i.e., this is why my gross profit dollars increase, is because I grew revenue quicker than I grew COGS. You can understand what drove that. You can start to understand what's going to happen in the future. You can say, what if I just attracted this new customer. It didn't increase my cost of goods sold for whatever reason. But if I can bring me in more customers like that, holding my cost of goods sold as flat as possible. Let's say in a service business where we see people, labor being in cost of goods sold, right? And then while you're under capacity, you can bring in more revenue across the top and maintain your cost of goods sold, but your gross profit dollars is going to increase, as will your gross profit margin. So I'm going down a little bit of a rabbit hole here, but the idea is it's going to be different from company to company. But once you start setting once you start measuring these on a regular basis, you can then start forecasting them as well. You can start looking forward, and you can start saying, I want to get my gross profit dollars up by 10%. How am I going to get there? Well, I know if I hold my cost of goods sold flat, I need to grow revenue. What do I need to do that? What do I need to do to do that? And those are the types of questions that come up when you really start measuring the data, when you start having confidence in the numbers you have, because you can start looking forward and being proactive.
Yeah. Hey, Jose, just to kind of, for emphasis here, I mean, so the habit is to look at the monthly financials, obviously every month, right? Like a scoreboard. It's kind of like, imagine if you're at pick your sport, a baseball game, and there's no scoreboard. You don't see anything that's happening inning to inning, or when the game's all over. I mean, it's very hard to know what's going on, right? And our business is the same way. So more or less, looking at the monthly financials is looking at the score at the end of the game, right? The end of that month, right? Which is helpful, right? Where do things fall out? And then the KPI, the key performance indicator for each key function of your business, starting with sales. How many phone calls you got to make to get one appointment? What are the key activities that you want to measure to make sure you're getting the result you expect? Or kind of like each inning of the baseball game, you know what the score is, right? And then even what player is getting what result. So that's where it fits in. And just imagine the baseball game and there's no scoreboard. I mean, very hard to know if you should stay the whole game or leave early, right? Kind of stuff. So
yeah, and to build off of what Kirk just said, one of the things we are very big on, and we do this with all of our clients at the very beginning, and we continue up, is we compare it to benchmarks. Just knowing, for example, that your gross profit margin is 30% for your industry doesn't mean anything unless you compare it to what other companies in your industry are doing. What if you find out that your gross profit margin for your industry is actually 35% and you're at 30? Well, then you start thinking about, what could I be doing differently to get to that 35%? For everyone else in my industry is at 35%. What do I need to improve on? What do I need to think about to get to that 35%? You can do that by every line. So as soon as you start doing these KPIs, it's important to start measuring them. It's important to understand where you're going. And it's important to understand where you've been. But it's also important to understand how you compare to your competitors and other folks in your industry. So you can start being smarter, start being better, start to maximize the value of your company.
Yeah. Just that level of clarity.
So the habit number 2, this is where I get really excited. So you guys might need to tamp me down a little bit. It's about managing cash. It's about generating cash. This is a common quote from a lot of business leaders. This one happens to be from Richard Branson. But never take your eyes off the cash flow, because it is the lifeblood of your business. Any growth you want to do is fueled by cash. And cash is fairly simple to understand. And I use the example with a lot of folks. Think of it in terms of a cigar box. When I had a small business when I was growing up, I knew how much cash I started the day with. Might have been 50 cents. And by the end of the day, I was hoping to have $1 in my cigar box. And that's how I start to measure cash flow. Now I've become a little bit more, sophisticated, but the idea hasn't changed. It's about cash and how do you manage that cash? Because you're going to need that cash to grow the company. You're going to need that cash to pay to pay vendors. You're going to need to get the cash from your customers. These are all the types of things you need to be thinking about, because this is what's going to drive your company. So moving to the next slide, one of the key tools, it's really simple, but like everything else, the devil's in the details, is create a cash forecast. We focus on a 12-week cash forecast, which then, depending on the client, and certainly with my clients, then we break up into a quarterly cash flow, or rather the next quarter, and we start looking at it longer term. But you need to understand how much cash you start the week with in the simplest terms. You open up your bank account, you say at the beginning of the week, I had $1,000. This week, I expect to receive $500 from vendor or from customers. It might be AR, or you might get paid as the service is rendered. And then I've got to make payroll of $200. So you're going to have $500 coming in, $200 going out. what does that leave you with how much cash at the end of today? You can do that on a daily basis, on a weekly basis, but you start getting into a rhythm, into a cadence where you start to forecast this, right? And you start to understand how much cash you have. So at the end, so the way I deal with one of my largest clients, every week we sit down and forecast out 12 weeks. And then I take that 12-week forecast and I put it into a longer term forecast. But the idea is I know how much AR I expect to receive this week, how much, payrolls every 2 weeks. We've got that in the forecast already. We know on average how much we're paying vendors. We know what our AP batch might be week by week. We start making those estimates. And then, the estimate this week is usually pretty good. The estimate next week is good. The estimate the following week is, okay. And then after that, it's a pure estimate. But still, you're starting to understand what's going on. And the important thing for any company, especially in growth mode or in survival mode, let's just say companies that are just trying to survive through COVID right now, is that you're able to be proactive. You're not reacting to how am I going to make payroll tomorrow? You're already thinking, what if you had your forecast in place? You go, hey, you know what? I'm going to have trouble making payroll 2 weeks from now. So what do I need to do now to fix that? Do I need to bring in receivables? Do I need to start making phone calls? Do I need to maybe push out payables, right? Do I need to call my banker and just say, hey, look, I'm going to draw on my line of credit if you have one, and here's why. And bankers like that kind of stuff in reality. They like to know that the business owner, that leader, is on top of it. They know the business. They're going to take a bigger risk on you or more risk on you if they know and you show them that you know the business. So the 12-week cash forecast is huge. It really allows you to start thinking forward, start to being proactive, allows you to breathe. A lot of times when we get a new client, what's happening is that they're on fire. The boat's listing and they're trying to figure out how to get that cash in the door in the next 3-4 weeks. And we try to get in there and help them. But the first thing we try to do is get them to a position where we're being proactive and we're no longer reacting to things. And the 12-week cash forecast is, in concept, is a very simple tool. The devil's obviously in the details, but it's so, so powerful.
Yeah, and one of the key things is just, even if you just start with the bank balance minus outstanding checks and 1 week looking forward, just do that. And the next week, go out 2 or 3 weeks. And that consistency, the skill will develop where now you can start to see further and further out and just, the short term matching the money in with the money out. And if there's a problem, the sooner we see it, the better.
Absolutely. It's about getting into it's like everything. You get into a cadence. And the first few times you do something, it's a little lumpy, it's a little uncomfortable maybe, but the more you do it, it starts to become part of, you get muscle memory and more importantly, start to get the right language. We get very quickly into shorthand with our customers because we know where the hot buttons are. We understand what your priorities are and we focus on those priorities. When we start talking about to get to X, we need to do Y. We know how to do it. And tools like this and the cash forecast is what I spend a lot of time on with folks is really important. But it goes back to peace of mind. It goes back to being able to breathe, take a breath, think about where you're going to be 2 weeks from now. So you're not worried about what's happening today or what's happening tomorrow. You're going to have to worry about that stuff anyway. But if you start thinking further out, it's just, man, to be in control of your destiny is the best thing ever, right?
Yeah, and Thomas brought up, he actually provided a comment in the question where he was talking about in the pandemic, he took his eyes off day sales outstanding, the average time between billing and client, which speaks, Thomas, that comes right to this slide here that Jose is going to walk us through about the cash conversion cycle. Yeah,
we can talk on Joan's question around moving from one revenue stream to another. What a lot of people don't realize or perhaps don't internalize is that you've got cash. Cash isn't only what's sitting on your bank account. You've got cash tied up in your business, and the way you look at that cash by opening up your balance sheet. You're going to have cash tied up in accounts receivable. You're going to have cash tied up in accounts payable, and depending on your business, you're going to have cash tied up in inventory. The simplest way to think about this, right? Accounts receivable. The simple answer is this. Oh, you want to bring your accounts receivables in, you want to stretch your account payables out, and you want to turn that inventory as quickly as possible. That's all great. Everyone understands it. But let me posit something out there I want everyone to internalize. When you have a receivable outstanding, you're giving that person a loan. You're giving that customer a loan. You say, hey, you don't have to pay me for 30 days. You're lending them your cash. Think about that. When someone is extending you a payable, when it's a vendor and he says, hey, you don't have to pay me for 30 days, he's giving you a loan. He or she is giving you a loan. When you start thinking about this portfolio you're managing, and then in the middle of that, so to speak, and the way I've got this particular diagram, you have inventory. Your inventory might turn quickly if, let's say, you're in foods, it's less, shelf stable. It doesn't turn as quickly. But start thinking about how you manage your balance sheet in terms of a portfolio. How can you bring in that? You don't want to be giving people loans, or more importantly, you don't want to be giving people loans that might not pay you. So that starts to change how you think about the terms you have with customers and how you might interact with those customers. Same with the payables, right? You're going to know who's going to be asking for that money right away and who might give you those 30 days. You start thinking about, how do I manage that portfolio of cash flows? Cash in on the receivables, cash out on the payables, and inventory is a mixture of the two. But you start thinking about that. So when we first do an analysis, we look at what are your days payables? What is your days, your receivable days? What is your payable days? What are your inventory terms? And then we compare it to a benchmark, which I just brought up before. If the rest of your industry is turning inventory, in 5 days and you're only at 3, how do you increase that by 2/3? If the rest of the industry has receivable days of 20, but you're at 30 or 35, why is that? Do we need to rethink your contract with your customers? On the payable side, if you're paying on 3 days, but the industry average is 30, why are you paying so early? Those are the types of things that when you start tracking it, you start putting that into a KPI, into a scorecard, you start to understand, you start thinking about it. And then we can quantify very quickly and somewhat easily, right? Is how much more cash would you get if you were able to bring in your receivables by 2 days, push your payables out by 3, and let's say just spend your inventory more by 1 day? That's cash in your pocket.
It really tells you, is it worth taking certain action to accelerate that? Can I bill faster? Can I collect faster? Can I get a deposit? I mean, if it's worthwhile, yeah, you're not locked into any traditional way of doing anything. So yeah.
Yeah, and as an example, and maybe you can't do anything. People go, well, I've already signed these contracts with these customers. Terrific, you're set at these days. But when you sign a new contract, you bring in a new customer, right? Make those payable days or make those receivable days shorter. Get customers, instead of sending you a check, get customers on an auto debit plan, on a credit card. So collections happens automatically. Those are the types of things you want to think about. Same with the payables. Hey, you might have set contracts with certain vendors right now, but when you bring in a new vendor, negotiate an extra few days, negotiate the 30, negotiate as much as you can. And then when you're actually day to day, start understanding how you're bringing those monies in, right? Every month, every 2 weeks, whatever it might be, look at receivables outstanding. See if you need to be making phone calls. It ties back to your 12-week cash forecast, right? This all ties together. We're connected, we're going to help you connect the dots. On the payable side, same thing, right? Understand, when is the last day you can pay this payable before it's due? And I've got, I put processes in all my clients to that effect. We pay every payable on time, but never before it's due, right? So we know when, if we send something out, if we're sending a check or an ACH or paying by credit card, or if it's auto already, we know when it's going out the door. We built it into our cash forecast and we know what's happening. Not to say that every now and again there's a surprise, but once again, we built this cadence, we built these processes. We're able to look forward, we're able to breathe. I keep coming back to that because that's so important for any business leader, right? Any startup, anyone who's in transition mode, being able to breathe, think about it, be proactive instead of being.
Yeah, and just kind of pack it in. If there's one of these measurements that really drives a result for you, it's a perfect KPI, right? Track that on whatever frequency makes sense, week to week, month to month, that kind of thing. Perfect KPI. Hey, Jose, I'm ready to step into habit 3.
Yeah, go ahead. Move on.
Okay. So habit 3. Hey, Valerie and Joan, I'm gonna kind of answer your question here. So habit 3, with habit 1, you're looking at the monthly financials, right? And you can see where am I over or under, what action do I need to take, and you're even better off instead of waiting a whole month to get your numbers, doing that weekly KPI, because then where's the kink in the hose? You got literally 52 opportunities to either if there's an opportunity, maximize an opportunity. If something's going sideways, you see it, put it back on track. So you're doing it 52 times a year versus 12, right? So the two hand in hand are really, really powerful. So habit 3 complements that. So now with habit 1, you know where you stand with your numbers, and let's forecast, month by month for 12 months out, that rolling forecast based on what I know now. What do I think is going to happen next month, 2, 3, 4, 5? And you just extended your visibility. And once you get that baseline, like we're showing here, the baseline is producing that 4.7% of net income. Well, critical thinking. Let's do the fun part of the business. Let's engineer profitability. Well, what if I go after my ideal client and I can get a price premium, but I'm driving so much value for them? A price premium in this example is 1%, right? That's not much of a premium, but it's a small example to show a big impact. What if I'm teaching my P&L managers to really manage their costs to get that quality outcome for my clients, where I can reduce my direct cost by 1%, right? What if I manage my overhead just 1% better? I mean, 1 plus 1 plus 1 doesn't seem like too much to ask, but it produces a 39% increase in profitability. What if 5%, right? And then so you start to engineer household income. What do you need? Bottom line, right? And then once you have that roadmap laid out, the detailed roadmap month by month for the next 12 months, that goes right into your monthly financials, so you're able to compare. What is that number story? Am I over or under? Very powerful, right? And that critical thinking. This is not your grandfather's budget. This is the one that sits on the shelf. This is the one that really empowers you and gives you visibility, 12 months down the road. It's a skill. The first time you do it, don't let perfection keep you from putting something down on paper. Just go with what, based on what you can readily know now or expect, put it down in the spreadsheet. And then as you do that, as you reforecast throughout the year at certain points of your business cycle, you get better at it. It's a skill. You get better at it, and you get really good if you teach your sales managers and your delivery folks to participate with you, where they own their numbers. Extreme ownership, very powerful. So let's combine habit 3 with the habit 4, driving performance. Jose had mentioned this. How do I know? Hey, I got 5% on the bottom line. Is that good? I mean, I don't know. It's better than negative, right? But if you look at the competitive benchmarks for your industry, then like in this example, the company was doing 2%, 30-year-old company. I thought, 2%, 1.5%, 2%, that's normal. That's good, right? And when they found out that no, the average company, not even the top percentile company, the average company is doing 10%, so 5 times that profitability. First there's some reality's got to set in. It's not judgmental. Now I know. Before I didn't know. Now I do. And the only question is, do you want to do the work to beat 10%? You don't have to. If you're okay with 2%, stay with 2%. And in 5x in profitability is not going to be easy. If it was easy, would have already done that. But now we know, and we can figure out why we're different, and we figure out, we don't want to replicate somebody else, but what's unique about us? What can we do better, right? We can get 12%, 15%. And the same thing with the current ratio, measurement of liquidity, how much do we have? In this example, the company has $1.29 for every dollar liability, so they're okay. But the average company has $3.27 for every $1 liability. Probably a little bit easier to make payroll, make your tax payments, put some money aside for a reserve. And the numbers, it takes that gut and it kind of breaks through any noise to where you get crystal clear, where am I at, where do I want to be, how do I compare to my market? And that goes right into the valuation. If you got a business that's not dependent on things like the owner, then and you got a good recurring future revenue stream, then your valuation is going up. So the best practice to have it is to do your valuation once a year, a manager level valuation, and that way what's giving us lift, what's giving us drag, and is that thing is it a priority now for us to address, so that you're building things early based on where you want to end up. And just to address, Joan brought up a question, like if you're in transition from one revenue stream to another, or you're doing a startup, it still works. If you're in transition, going back to habit 3, work it out. I'm going from A to B, work it out in that 12-month, that rolling budget forecast. And I'm doing this now, and at what month are the influx points? What costs go along with that? And on the bottom line, what's happening? Am I still making money or am I losing money? So work it out, based on what you can reasonably expect, and then that becomes your roadmap in your financials. And if you're doing better than expected, you'll know it. And if you're doing less than expected, you'll know it. You'll know where to take action that month. We're not waiting until the end of the year. So it doesn't matter where you're at, startup, or you got a mature business, you're doing something new markets, new products, whatever it is, work it out with the numbers, right? So that you can make sure that the financial resources are there. And then,
okay, Kirk, can I just step in one quick second?
please,
You're a startup and you have some investors, for example, they will ask you what your cash burn rate is. So you will have to prepare what you're going to be spending on, like the research, salaries, whatever other expenses. So even if you're pre-revenue and then you just have some a pool of money to use, you will be asked to do the projections as well. So that's even pre-revenue and pre-anything. So
it helps you. If you get an investor, it helps you. If you get a loan, they're all going to look for these financial controls where you can see where you're coming from and where you're going to, and you can engineer the outcome versus just letting things fall out. And so Valerie, I'm going to answer both of your questions. You had a comment earlier that you're looking at Beta SAM, which is a government contracting database, to see what procurement officers are buying and what type of stuff. It's really based on contracts, but it has the officer's name there. Just as a tip, we did a webinar a few weeks ago with Judy, and she showed us how, hey, don't chase the contracts, but actually identify who the buyers are in your space, figure out what they're buying, and develop a relationship with them so you know what's coming, and you can actually kind of sell based on what the buyer is buying, even in the government, the procurement officers. So that's on the website. If you can't find it, just email me. I'll send it to you. But Judy has kind of a way of analyzing the data in that Beta SAM where she can say, okay, there's my buyer. There's the one I need to get close to. And then the current question is the place to find. There's two places to find benchmark information I know of. One is if you go to a library. A lot of them have, even online, they have services to like a business benchmarking services, so you can get it there. If you can't find it, then email either me or Jose. We subscribe to the same competitive benchmark database that a lot of banks use. When you go to a bank, this is how they look at you. How are you doing compared to your industry? So naturally, we want, foresight, right? We want to know what they're going to think. First of all, we want to drive outcomes in businesses. And secondly, when we go to raise money, we want to know what they're going to think or take on debt, what they're going to think before we go, so we can position things in the story that makes sense for them to lend money to us, right? So that's two sources of good competitive information. Okay, just to make sure we respect time here, I want to take the next step into habit 5, identifying the right options. And Jose, can you lead us through here? We got probably just a couple minutes before we got to wrap
exactly.
up.
So we got a couple minutes. One of the things we find, it's very easy to get overwhelmed, right, by the challenges and all these decisions you need to make, and where should you focus? One of the tools we use, well, the first thing is that you identify the right options, right? You have to figure out where am I going to get the most bang for my buck if I focus on this? And it's all going to tie back to your KPIs and so forth, things of that nature. But it's really about identifying those right options. One of the tools we use is the 2% CEO score. And this is something we ask all of our clients to take once a year. A new client takes it right at the front end. And then on an annual basis, we ask our clients to take it because it highlights 8 drivers. I'm just going to mention them. You can see them there. Financial performance, growth potential, dependence on, your dependency on a customer, on an employee, on a supplier, your positive cash flow, your recurring revenue stream, that's important, your uniqueness in the marketplace, customer satisfaction, and what we find a lot, owner's trap. And by taking that 2% CEO score, it'll start to give us an idea of where can we make the most improvement the quickest. Now, once again, that all happens in deep conversation and goal setting and understanding priorities. But this is a tool that really allows us to really start to kind of zoom in, distill, where can we have the most impact? Can we do it with regards to cash flow? Can we do it with regards to, top line growth? What can we do to get more recurring revenue streams? Or what happens a lot with a lot of folks that have started a business is, how do we start to alleviate that owner's trap? How do we allow you to get out of running the business and really thinking about the business, right? And this is one of the things we do as part of Habit 5. It's really identifying what's the right option. What should we be focusing on that's ultimately going to generate more cash, and all else being equal, increase the value of your company.
Yeah, and it makes sense, right? If the business is not dependent on the owner, you actually have a business, right, versus a job. The business is more valuable because when you go to transfer it, you don't have to stay attached to it for a 2.5-year earnout. Uniqueness, right? What makes you more unique? That's going to have a strategic value both to you now from a pricing premium, and so that you get more household income, more profitability. Plus tomorrow, it's better to have a strategic buyer have an interest in you than just a financial buyer. Right. So on average, based on a database of 34,000 private companies, when a business is scoring 80 plus on the CEO score, we know that for a fact, on average, that business is 71% more valuable than the average competitor in their market space. Right. And it makes sense, right? You got financial performance and customers are satisfied, you're not dependent on the owners or key employees, right? Recurring revenue. So it makes sense, but by having a measurement, it just tells you that much easier where to go do the work. Okay. So Jose, anything else you want to add here before
Not on this one. I think we can move on. But we spent the last probably 15, 20 minutes was really talking through the 5 habits, and we gave you an overview of what they are, how to think about it. But it really comes down to you. I can tell everyone we need to be proactive. That's what we want to do. We want to get from a position of being reactive to proactive. Double down on offense. A strong leader, like the case study I brought up, my telco company. That CEO understood what his weaknesses were. He understood what his strengths were. And he brought in the right people. He partnered with the right people to get his company to where he wants to go. And it's a journey. And the best way to get through a journey, I'm getting into these little cliches, I apologize. But it's, find the right people to take that journey with you that are going to get you there. And that's that's my last note to you on this one.
Yeah, and just to kind of answer, Thomas had 2 questions. One is, what percentage of revenue should any one client not exceed? A lot of guys said not to exceed more like than 10 to 15%. And even if you have different contract vehicles as a government contractor with one agency, you got some dependencies. And if you don't believe that, then you haven't seen the shutdowns that are increasing with frequency. So that's a good number. If you have concentration, your business is a lot less valuable.
Yeah, it's going to depend. It's going to depend on your mix of variable versus fixed costs. Also going to have, it's also going to have some implications on, how many different, what your customer portfolio is going to look like. I've got a client who, the top 20 is 50% of their revenue. The top 50 is 80% of revenue. And I would argue, knowing their cost structure, we know that it's a little, we need to diversify a bit more. We need to figure out how to get there. But it's going to depend from company to company. But at a certain point, this is one where the numbers will help you pinpoint what that number could be for your company.
Yeah.
For your business specifically.
And again, okay. And it is Thomas' second question, and then we'll wrap it up. Is what is a good number for reserves? It really depends on those payment cycles. I'd want to have at least 3 payment cycles of cash available in case something comes up. That gives you 3 months or 3 cycles to adjust if there's any shocks to the system.
Yeah, so, that's a good rule of thumb. You figure out what your payroll is, right? You figure out what your average payables are, and that's where you start to kind of figure that out. But but once again, you need to understand your working capital. How much have you got tied up in AR? How much have you got tied up in AP? How much have you got tied up in inventory?
Yeah.
But think about it in terms of 3 cycles so you can plan ahead.
Yeah, have those numbers. And so let's bring it home here. So the double down on offense. Do the work and take your shot and then monitor the numbers. So if something's going sideways, you see it. and then you can step in accordingly based on what it is. So to bring it home here, what we do, we guide CEOs to help them use the numbers to win more customers, keep the customers they have access to capital on good terms, build the people capacity to both sell and deliver, and then those achieving those strong financial results. And we do it with the numbers, and we do it through growth, CFO, and accounting services. So we're going to send the slides out to everyone, and the purpose of this event is to make you aware of those really proven practices, which we kind of teach, implement, and follow through on through the 5 habits of profitability. Have good numbers. That's your foundation. Manage your cash well. Create that financial roadmap where you're engineering profitability, no matter if you're in transition or if you're scaling, whatever it is, new business. Drive performance with benchmarks so that you're not isolated to just what you know internally and in your evaluation. And then with those 8 drivers, identify the right options, right? Because otherwise, without having some kind of lens to look through, like the 8 drivers, it's just infinite. I mean, where do you get started? There's so many things you could do. So if you're interested in learning more about how we help you use the numbers to really accelerate into 2021 and beyond that, then shoot me an email, and I'll send you a counter invite, and we can hop on a call and talk more about your business. Giselle or Jose, you want to say anything before we say goodbye and thank you for coming to our audience here?
Well, that's all I'm going to say is thanks for spending some time with us. And as you can tell, I get pretty excited about cash flow and generating more cash.
Well, I think my parting words is that a lot of CEOs, I used to be an SBDC advisor, and I used to mentor other startups, is that a lot of them are afraid of finance, and you should not be afraid of finance. It's just numbers. So, and as Jose pointed out, it's muscle memory. The more you do it, the better you get at it. And if you need help, there are a lot of mentors and counselors out there who can guide you, including at the SBDC, and at a different level, of course, Kirk and Jose. So just don't hesitate to reach out to people, because there are a lot of people there who know how to help you.
Yeah, and if you don't know Giselle's program directly, a lot of good resources there, including Workspace. If you're in this area, good resources, wealth of experience. So if you don't know Giselle, you probably should do that. Probably get to know each other a little bit. Okay, so 2021. Thank you for jumping in with us. The habits, the numbers, these habits complement what you went into business for. So at whatever stage, putting them in at the right level for that stage will help you anticipate things, and you will avoid stall points, which is always good. So see you around, and we wish you all well.
All right, thank you, everybody.
Yeah, thank you.
Thank you. Bye-bye. Thank you again. Bye-bye.
Let's see. Okay, Giselle, thank you. Hey, I guess it's just us now, right?
I don't know, to be honest.
Let me end it. I lost track here. Okay, hey, Giselle, I'll call you, okay?
Yeah,
Okay.
and I'm going to hop on to my next call.
Yep.
Giselle,
Okay.
pleasure. And anything I can help with, obviously think of me. And maybe you should go grab coffee at some point once we kind of get back to some kind of new abnormal here.
Right. Yeah, I actually live in McLean, so
Oh, do you? Okay, whereabouts?
in McLean Hamlet, which is very close to Spring Hill Rec Center.
Yeah, I'm actually. I live right. I live 2 blocks from Total Wine.
Okay.
You know exactly where I'm at. We got a lot of friends who live in the hamlet. All right,
Okay.
guys. Have a good afternoon.
Okay.
See you later.
Okay.